Hi, today I want to solve this problem, use this financial calculator. Okay, this problem is saying Maggie's friend Cindy told her there's an investment opportunity. It will require Maggie to invest $50,000 initially and then invest $10,000 at the end of each year for the next 4 years. So she will receive 120,000 at the end of year 5. So Maggie is wondering if this is a good deal. Her money is invested in a corporate bonds fund. Earning is 7% interest income. So basically you want to find out that one thing you're probably wondering, for this, the investment deal, what's the return, compared to 7%, right? So if I can invest in 7%, if this can give me a good, if you calculate all the returns, you basically want to find out the net present value. And so you want to find out the net present value. If it's greater than 0, you want to find out the internal rate of return, which is this new deal return. And if it's greater than 7%, if the net present value greater than 0, IRR is greater than 7%, then this is a good deal. So we can calculate this with financial calculator. So I show you a timeline of the cash flow. So basically say initially I invest $50,000, then I'm gonna invest the additional $10,000 at the end of each year for the 4 years. So at the end of the 5th year, so I'm gonna get a positive cash flow is $120,000. So basically this is your timeline. So those are the cash outflow. So this is the cash inflow. So okay, let's do this in the financial calculator. So first you go to second cash flow CF. Then you go to this. So if there's any data in it, you should clear all the data. Second, clear. So now you clear everything. Make sure everything is 0. So you cleared all the data. So then we input all the number. CF is your initial investment, $50,000. So it's a cash outflow. So you should put a negative sign in front of it. So enter. Then you this is cash outflow for the 10,000. They have a 10,000. So then you put a $10,000 is a cash outflow. Then you enter. Then this is tell you how many cash flow is 4. So you enter. Then this one is the cash inflow. So this is a cash inflow. So you don't have negative sign in front of it. So how many cash flow is only 1. So after you input this, then you do net present value. So when you calculate net present value, they require you put an interest rate in it. So this, in this case is 7%. So now then you use the scroll down arrow. Then is you press compute CPT, then give you a net present value is $1,686. So this is the net present value is greater than 0. So it's a good deal. Then we want to double check this. Use the IRR. So you want to check IRR, you simply go to IRR, right? Then you compute, press compute. They give you 7.53%. So IRR is greater than 7%, is greater than 7%. This means this is a very good deal. So yeah, so Maggie should take this deal. Then you want to if you want to double check your work. So basically you want to know how this works. So initially you have a cash outflow. This is your cash outflow. You want to all the $10,000, you have to discount them back to the present. So you get present value of the full $10,000. So you plus this is 5 cash outflow, which is the amount that you invest. So they are in the present value term. So present value outflow, you get total is this much. Then you do present value inflow. This is your at the end of the 5th year, you get a $120,000 that discount at 7% for the 5 years. So you get cash inflow, the present value. So net present value basically inflow minus outflow. So is this. So you get this is the net present value, which is exactly the same